Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Electronic Arts EA, the video game company, down 19% in the past 2 days after they sharply cut guidance for 2025 off of some disappointing sales during the holiday season. So the guidance cut, pretty significant. I guess people are getting a bit tired of the same game being released every single year. Updated range is about $575 million lower at the midpoint for fiscal year 2025 than the guidance they just gave a couple of months ago during Q2. Q3 guidance on net bookings down about 260 million bucks versus the midpoint of the guidance they gave before, and then net revenue for the third quarter, again this is the Christmas quarter, so very important for these companies, shy of 1.9 billion in revenues when the analyst community probably expected something closer to 2.3 billion. So that's really going to float into 2025 overall net revenue results, but some of these net bookings misses are probably going to float into 26 as well due to some of these deferred revenues. So what's going on here? You're talking about global football sucking wind, down mid-single digits at the midpoint of this new outlook when this is supposed to be a growth driver for them with a new game coming out, etc. Then separately, Dragon Age, one of their newer games, engaging approximately 1.5 million players. That is a weird word to use, and I know why they're using it. Down 50% from the company's expectations. And again, engaging means, hey, people got these games for free. Maybe they got demos. Maybe they played on EA Play or whatever. But end of day, it's not 1.5 million sales, it's 1.5 million engagements. And you know what engagements are? They're jack-ish is what they are. Basically, you're talking about nothing here. So what's the problem? Well, the problem is that the slate has kind of been the same thing for a while now. EA isn't one of those companies that has this massive game in the pipeline. It doesn't have your Grand Theft Auto. It doesn't have your Witcher. It's basically releasing these sports games year over year over year. And yeah, they have some other franchises like The Sims, like Apex Legends, like Battlefield, Titanfall, etc. Although I don't even know if Titanfall is a thing anymore. Dragon Age, obviously, which doesn't seem like it's that great anymore. But it's mainly these EA Sports games, especially EA Sports FC 25, Madden NFL, college football, that they release on an annual basis, kind of a refresh. Hey, here's the updated squads, better graphics, new game modes. Buy the game. The annoying thing about them too is that, hey, microtransactions are in the game as well. So you not only buy the game full price or maybe at a savings if you wait a bit, but you also have a level of microtransactions embedded if you want to play online with Ultimate Team and all that other stuff. Yeah, you can get some of that stuff for free in game if you play enough, but there's certainly an advantage to spending money. And while that's a pretty decent business model for a company like EA, they can make a lot of money and a lot of reoccurring revenue and the margins are really solid. It might not be beloved by a lot of people. A lot of people just plain out think EA sucks. For a variety of reasons. It is kind of a scummy business model that you're kind of releasing this game, charging more on top of it if you want to participate in the game fully. People don't love it. People don't love the idea that, hey, you're basically getting a 95% similar game every single year. How different is EA Sports FC 25 versus EA Sports FC 24? Not that much different. I've played both. Didn't really notice the difference. Again, I only played it surface level, maybe a couple hours here and there between the two, but at the end of the day, didn't notice the difference. Dragon Age is another good example of EA kind of missing the beat. They are working with a game producer, BioWare there, had significant layoffs there at BioWare, laid off a good portion of the team that worked on some of the old Dragon Age games that were well received. This one had some okay reviews, but who really trusts reviews these days? People online didn't seem to love it, said the writing sucked. Obviously, the sales just aren't there, so maybe those people are just leaving in droves because they're not liking what EA is releasing. And you're certainly seeing that in their results recently. You look at their results starting in 22. Yeah, 21 and 22, 18% growth, 21% growth. Certainly a boost from the pandemic, but also they had some acquisitions in there. I think they made 2 or 3 acquisitions, some of them mobile game focused because mobile games were all the rage at that point, maybe overpaid a little bit for those. And now that that growth is done, last 3 years are looking pretty mediocre. Negative 2% growth in fiscal year 23, 1.2% growth in fiscal year 24, and now probably negative 5 to negative 7% growth in fiscal year 25 with these reduced numbers. So not amazing, and that's certainly why the stock is performing the way it's performing. If you look at the last 5 years, this is a stock that was at 112 prior to the pandemic, is now at 116. So you're basically flat in the last 5 years, while the market has done nothing nothing but soar. So that's a problem for EA investors. They do pay a small dividend. The question becomes, is the valuation here solid at this new lower price point? And I guess the question would be, why would it be, right? They haven't really grown in 4 to 5 years. They haven't really done anything amazing. It seems like they're moving in the wrong direction. If you think about the reduction in 25 and even some growth in 26, your fiscal year 26 revenue might be lower than your fiscal year 22 revenue. That is not fantastic. The nice thing about this business, though, and like I said, the business itself is pretty solid from the perspective of EA, not maybe the perspective of the consumer, because it's reoccurring revenue, it's higher margin revenue. So even though it's not growing, it's still producing quite a lot of free cash flow. You're talking about 2.1 billion in fiscal year 24, 28% free cash flow margins. They've been as high as 30% before, and with all this AI stuff, who knows, maybe those margins will improve if they can become more efficient as a company. But 30% free cash flow margins. And do note that on the free cash flow side, they do have about 600 million in stock-based compensation, so that it's included in free cash flow, but not included in net income. So your EPS might be a bit lower than free cash flow when you have high stock-based compensation. We'll talk about that in a second. End of day, though, if I were an EA investor, I'd be a bit worried. I'd certainly be looking forward to the earnings call that's coming out in a few weeks for more guidance around what they're seeing past Q4 25, any guidance on 26, any ideas about pipeline going into 26. Are there any games besides just the standard EA Sports stuff in 26, because they're going to release all of them again in 26, surprise, that are going to drive a revenue growth surprise? Or is this just a one-trick pony that has a little thing on the side here and there, where if this EA Sports franchise struggles, they're in a bit of trouble? As we look at the valuation here, this video is purely for informational, educational, and entertainment purposes only. It is non-investment advice. Do your own due diligence. So as we look at the valuation, they do buy back shares. They've bought back anywhere from 500 million to $1 billion in buybacks after stock-based compensation. So they're buying back closer to 1.5 billion. About 600 million in stock-based compensation, so the real buyback is closer to 900 million or so. They do have a dividend. They haven't raised it in the last 2 years, so I'm keeping that at zero. You can change that if you want. As always, with these spreadsheets, just hit file, make a copy. There will be a link in the description down below. It is a $30 million market cap right now. When you think about their trailing 12-month free cash flow, a 6.9% free cash flow yield on a trailing 12-month basis, on a forward 12-month basis with a negative 7% growth assumption and a 25% free cash flow margin. It's closer to 5.6%. If you account for the removal of that stock-based compensation, it's closer to 3.7%, probably on a next 12-month basis, closer to 4.9% on a trailing 12-month basis. As we look at future growth, this is where it gets tricky. It's kind of uncertain. I'm thinking 25 is going to be a bad year. That's sort of locked in. They said that. Then 26 onwards, probably going to be relatively slow. I just don't see the catalyst for EA. It's like it's the same series of games. They don't really have that big wow factor game. Yes, they have some partnerships with companies like Disney for some Star Wars games, but a lot of those haven't really just blown the doors off any houses or anything like that. So I think there's no major catalyst here as far as I know. Let me know if I'm wrong. That's going to suddenly shift this upwards. They have to do a better job of making their main franchises become better revenue earners if they want to grow anywhere more than the inflation levels I have here. So negative 7% shrinkage, 3% growth, down to 2% growth for the next couple of years. Margins can improve, will improve. I think 27 to 30% margins are kind of the way to go. Majority of that free cash flow going towards buybacks, about 5 billion. Again, there's probably going to be more buybacks than that, but they're going to be offset by stock-based compensation, which I'm accounting for here. Dividends are about 1 billion. If you want to raise them, you can just put a number in here to do so. Then the question becomes, what's the right valuation for a company like this? Like I said, 7% on a trailing 12-month basis, 5.6% on a next 12-month basis. If I'm being aggressive, I'll probably put it in that like 5.5% range. So 50% on 6, 50% on 5. I think that's kind of historically where they've traded. You can probably be a bit more conservative given the negative 7% shrinkage and go 100% to 6% and just say this is a 6% free cash flow yield benefit company on a go-forward basis. If that's the case and you're looking for an expected return at that level after buybacks, after dividends, you're talking somewhere in that 8% range, which again isn't terrible. So you're sort of assuming that, yeah, growth isn't going to be there, but margins will improve. They're going to benefit from AI, more efficiencies, et cetera, to improve margins. A 30% margin business is certainly nothing to sneeze at. And if you can get it at a 6% free cash flow yield today and sort of get that in the future as well with improving margins from today's point, you're going to get a decent overall return. Most of that, not most of that, I mean, some of that is driven from buybacks. A significant amount of that will be driven from buybacks, some of that from the dividends, and then, maybe a 4 to 5% return from just growth, revenue slash earnings growth, then, 2 to 3% in buybacks, then another percent or so in dividends. That's how you get to your 8%. If you want to be a bit more aggressive, you can get maybe an 11% return with a 5% free cash flow yield, a bit more conservative down to a 5% return with a 7% free cash flow yield. So with that in mind, if I'm targeting something like a 10% return, gets me to a fair value somewhere around 104.16. Again, if we go back to 50-50, closer to 5.5% free cash flow yield, gets me to a fair value that's right around where it's trading at today. But that's probably too aggressive given what we're seeing, the headwinds we're seeing, the fact that they're suddenly just losing their biggest franchise growth opportunity, and now it's shrinking by mid-single digits. That's a big shift in the business dynamic here. And if that doesn't change, then you're in a bit of trouble. So you probably want to be a bit more conservative here than aggressive until you hear more. For me, for something like this, I'd probably need something like a 15% target return if I wanted to own it. I have owned EA Sports in the past, EA Electronic Arts in the past, when it was like in that like $90 range. That's when I was a buyer. It ran up into the 130 range. I sold out. It kept running after that. But since then, it hasn't really done anything. It's sort of just been in that like 130, 140 range for a while. Now it's obviously below that. The revenue growth just hasn't been there. You're talking about shrinking by 600 million in revenue between 22 and today. You're talking about free cash flow that's probably relatively steady, maybe margins improving a little bit, but the top line obviously shrinking. So what's the exciting part about this business? Really nothing. You would have to get it at a really attractive valuation for this investment to make sense. And certainly you could make the case that, hey, you're getting a 5.5% free cash flow yield on a next 12-month basis. That's pretty good. This is a business that's not going anywhere. If you look at the 2008 recession, this thing didn't shrink. This thing had positive net income for the most part, slightly negative in 2009. But end of day, even if this business shrinks a little bit, it's still going to throw off a bunch of free cash flow if you can get it at the right valuation. And that right valuation probably needs some margin of safety, maybe in like the low 90s range, with the buybacks that they're going to throw off, with the potential for growth eventually, even if it's a slowing growth for the next couple of years, with improving margins. This could still provide a decent return just on the basis of slow growth, slightly improving margins, decent sized buybacks, and a small dividend. Can you get to 10% plus if you're starting in the low 100s and the 90s? Totally. Can you get to 10% from today's prices? It gets a bit more murky just because 25 looks so bad. So those are my thoughts on EA. Let me know what you think. Am I wrong? Am I right? Am I missing anything here? Do they have any games that are out in the pipeline that you know about that are going to suddenly change the projections on the revenue side from what I'm showing here? If so, let me know with a comment down below. Again, if you want to play around with this spreadsheet, file, make a copy. There will be a link in the description down below. Otherwise, thanks for watching. Leave a comment down below about anything you want to comment about. If you want me to review any specific companies, let me know. There's a bunch of earnings coming out, so I will be back with more videos. In the meantime, thanks for watching. Have a good day. Bye. Like, subscribe. Bye, bye, bye.